We're Compound Everything. We talk money, markets, and investing. And today we are talking about cognitive biases that may hinder the investor.
Right. So I thought of something the other day. The thought was that, the financials are important. You need to understand finances when you're analyzing a business. Part of investing in the stock market has to do with emotional fortitude. Mm-hmm. It's very difficult to make an investment and then watch it drop by 50% and still maintain that conviction in the investment. Or, likewise, maybe it doubles or triples, and then you decide, oh, maybe this is a better business than that. I'm going to keep holding it, all to see it, drop back down to, below your initial purchase price. So emotional fortitude and psychology in investing, I think, may be just as important as understanding the financials. So I think Ben Graham said this best. He said, this is a quote, it says, "The investor's chief problem and even his worst enemy is indeed to be himself." Mm-hmm. So psychology in investing is extremely important. Mm-hmm.
And one of the reasons why the psychology or the psychological part of investing is harder is because numbers just stay the same.
Right.
Like
they're objective.
Like a number is a number. I shouldn't say the numbers stay the same because earnings are growing or decreasing or whatever. But if they make $2.25 a share in a particular year, that number means $2.25.
Yeah.
Outside of some accounting, this, that, and the other thing. But you know what I'm saying. Whereas psychology changes. It can change on your sleep, your how you feel. It can change on if you're going through a hard time in life. Maybe you've just been diagnosed with something, or you're going through a divorce, or maybe you're on a high because something really great is happening. And so the psychological aspect of investing is so difficult because it's so fluid in part. And we're also really good at lying to ourselves about how great we are.
Right. Well, interestingly enough, too, markets are kind of interdependent with people, obviously, right? People make markets. So people's psychology was going to drive markets. And we actually saw an interesting phenomena happen recently. So with the whole Wall Street bets and the whole GameStop saga kind of repeating, and we saw GameStop appreciate, what was it, 100%? It happened in a very short period of time. So you see market psychology playing through here. So what ended up happening, for those who don't know, is I guess one of the original people who got the meme stock craze going just posted a random picture on X or Twitter or whatever you want to call it now. And people took that as a sign that something was happening and ended up bidding the stock up like crazy.
Nothing had changed in that moment. From the time that Roaring Katie put up that picture and the company, nothing had changed within the company. Nothing at all. But all of a sudden, investors took that as
a cue to
buy, and buying begat more buying, and on and on and on.
And so it's market psychology. So we thought, wow, that's really interesting. And again, of course, markets are dependent on people. So there's almost like this interwoven relationship in markets between psychology and finance. And I don't think you can separate the two of them.
I think when money's involved, that's always going to be
It's always emotional.
Like money is makes people very emotional. I mean, you see, like, money's one of the number one reasons couples fight. Money tears families apart. Money makes people do crazy and horrific things. Like, money just brings out sometimes the worst in people and even in ourselves. And it might not even be like evil or bad, but it's just misjudgment.
Well, you quoted me a study a little while back about, loss and then gains, and how people are disproportionately affected by a loss.
Yes.
And they're not so if you lose $100, you will not be as happy if you gain $100 as you would be as sad if you lost the $100.
Even if it's the exact same amount.
Right.
It's the same with negative and positive events.
Yeah.
Right? Negative events stick in our brain. We remember them. We stew about them. And then positive events just slide right off, as if they didn't happen. It's just an unfortunate aspect of a fallen world.
Yes.
Yeah.
So let's talk a little bit about biases. That's kind of our introduction. So let's talk a little bit about biases. I like to define biases in terms of being either cognitive, so errors in thinking or biases in thinking, or emotional. Yes. And so things that play on my emotion. Of course, those two things are intertwined because, your rational brain is affected by emotions and, vice versa. But at the same time, I know myself and I know I have certain biases that I am, we'll call it, prone to.
Right.
So, and a lot of them are emotional. Funny enough. And maybe I just haven't done a deep enough dive to figure out my cognitive ones.
So I think in the academic world, they take cognitive biases and they call them heuristic, and they take emotional biases and they call them framing. And I just remember like framing biases as feelings. Oh, okay. Framing and feelings both start with F. So how do I frame this? How does it make me feel? Okay. That would be like an emotional bias, right? And then cognitive is just mental shortcuts. And a mental shortcut is just something that we as humans do, because if we didn't do that, our brains would explode, because we would have to take in so much information and contemplate and think about and manipulate so much information for every little thing in life. We literally wouldn't get anywhere. That's why we have cognitive biases. They're not bad. It's how we
survival.
It's survival. It's like you're making decisions all the time. Sure. So if you didn't have these mental shortcuts, you wouldn't be able to function in the world that we live in.
That makes total sense.
Right. So an interesting one maybe would be like recency bias.
Sure.
Right. So recency bias. So maybe let's go back to GME. The reason why everyone got, like, ooh, it's going to go up again is because in their mind recently, not that long ago, GME really
2021.
Right. Went up to $480 a share.
Yeah. From like single digits.
Right. Of course, there's a couple of biases going there, anchoring, whatnot, but that'd be recency. That's why they were thinking that. But recency bias isn't always bad. I mean, if I get sick on something and I get, I'm throwing up. Sure. Right? I'm going to avoid that food. Right. Recency bias is going to tell me, like, don't eat that.
It's a survival skill.
It's a survival skill. And, you wouldn't be able to function in this life, like I said, if you didn't have shortcuts and ways of thinking. But sometimes these same things that help us really hinder us, and they tend to really hinder us when we talk about investments.
That makes sense. I guess also because there's that part of our brain that's kind of emotional and reactive, and you've got the whole kind of thinking fast and slow kind of an idea. So our fast decisions tend to be more based on emotion, whereas our longer decisions may be a little bit more thought out.
And you have said to me, like, when you're stressed out, your body, your brain doesn't know if you're stressed out because your portfolio's dropped in half, or because you're fighting for your life against some attacker.
Has no difference.
Your brain doesn't know why you're feeling that way. So all those triggers in my brain and all the adrenaline and all that would come out if I was getting physically attacked are the same things that are happening in my body if I'm watching my portfolio drop 50%. And I have to be aware of that and step back and think like, okay, how can I handle this? How am I reacting to this? What are the biases that I tend to lean into? What are the horrible decisions I'm going to make because my adrenaline's going, I can't even think straight right now.
That's right. So these are things that you want to kind of plan out beforehand. Some of these biases, know that you have them before you're making an investment. And then maybe it'll better inform your investment decisions. And I'm actually getting fairly convinced that the difference between maybe a mediocre investor or trader versus a very successful one is probably more so due to temperament, more than any kind of secret sauce in terms of, potentially academics or financial decision making.
Like you said, you need the finance, you need the knowledge, but then after that, you need that psychological fortitude.
That's right. You need to be able to buy a stock that no one else wants. Right. When no one else wants it. Right.
And then sell a stock when you're watching it go up because you're like, this is getting crazy. And sell a stock when everyone wants it. Right. Yeah. Okay, so that is a super long introduction to what we're talking about. So why don't we run down, I have a list here. I'll run down all of the biases we're going to talk about. Sure. How they're broken up. And then we'll kind of just get into each one individually.
We'll just pick them up.
Some of them will take more than others.
Sure.
Okay. So we broke them into cognitive biases and emotional prejudices. A lot of them overlap, but that's how we did it. So the cognitive biases are overconfidence, representativeness, anchoring, framing, cognitive conflict, availability, mental accounting. And the emotional side is loss aversion, optimism, and status quo. And there'll be a few other ones in there that aren't mentioned in my list, but...
Right. I'd say we've added a couple, one being FOMO.
Yeah, and actually, in what I've looked in, and you guys can correct me if I'm wrong, but FOMO doesn't come out as an individual
bias.
They often lump it into other ones, but I really, in investing, think that FOMO should have its own category.
Hands down, no question. I struggle with that personally.
Yeah, you do, and who doesn't? We're not professionals, so we're going to actually take the liberty of making that.
We're going to make our own.
We're going to make our own because we're not governed by any.
Well, and here's the thing: the whole point of that is to help ourselves to understand our own biases and to help you, our viewers, to understand yours.
So let's start with representativeness. Sure. This one was really interesting to me, and one of the reasons it was interesting to me is because this is a bias that you can actually use in your favor if you use it against other people.
Sure, that makes a lot of sense.
And that's the whole problem with studying psychology is that you can actually use it against others
I mean,
use it as you will. Take that as you will. Yeah.
I mean, at the end of the day, markets are competition.
Yeah.
So, I mean, whatever gives you a competitive edge. And if we said that the difference between a mediocre trader and a very good trader is psychology, then maybe that's what wins. So what is representativeness?
Okay, so that is basing what you think is going to happen in investing, because these can happen in different areas.
Yeah, we'll just say strictly based on
all of these are for investing that we're going to talk about. So that is basing a stock price on recent movement.
Okay.
And so if a stock has gone up recently, then you think it's a good investment.
Okay.
And if the stock has gone down, then you think it's a poor investment. And I can give an example and then you can give one. So for me, I've been looking at Lululemon.
Sure.
Now, I'm mainly a fundamentals person. I don't do a lot of TA, if any. I don't even know much about it. I'm not a quant.
Yeah.
I'm strictly a fundamentals person. Now, I've looked at Lulu. I'm wearing Lululemon tights right now.
You are, yes.
Yeah.
And they're very nice.
My daughter loves Lululemon. All her friends love it. And, you know, it's been a Wall Street darling, so that's a little bit concerning. But recently their stock has been going down.
Right.
Now, this has been on my watch list for a long time, and I want it for a particular price. And now that it's going down, I'm thinking like, well, is there a reason it's going down?
Right.
Maybe people aren't wearing their clothes as much anymore. Are their earnings going? And I'm starting to second guess myself simply because the price of the stock has dropped.
Well, and funny enough, if I had asked you a year ago or 2 years ago or a year and a half ago when it was over $500, would you like Lululemon at $300? What would you have said?
I mean, heck yes.
You would have said hands down, no question, yes.
Like back the truck up.
Right. So
under 300.
Right, exactly. So at this point now, you're lumping that stock in as being representative of a bad investment because the stock has dropped. But ironically, the bias works against us in this regard because if all the fundamentals in fact of Lululemon, we'll use this as a hypothetical example, are the same, then actually the fact that it's now $300 as opposed to $500 makes it a better investment, not a worse one.
And you know what's crazy? I know that. I know all of this because I do value and I do event investing, but it's still hard.
Yes.
It's still so hard. But what I meant earlier when I said you can use this in your favor is if you know that there's a psychological bias that makes people think a good investment is based on recent movement, then you can actually hop in when it first starts moving and get out fast.
Yeah.
It would be
that's momentum.
Momentum. And I heard an investor, pretty good investor, say like he does this, but he said like it's like he's like if you're value investing, you can go like 80 kilometers down the highway, take it slow. If you kind of miss a turn, it's not a big deal.
Just turn around.
Yeah, but he's like, if you're a momentum investor, it's like you're in a Lambo, you're like flying. It's like
you're going
one
200
bad
kilometers
turn,
or 200,
you're dead.
Yeah, 200 kilometers an hour down the highway.
Yeah, and that makes sense. But I read this, I was like, oh, this is exactly what he does. He uses the momentum.
I like that example.
Yeah, he uses the representativeness of that bias of other people knowing, oh, if it's starting to go up, more people are going to be like, oh, that's a good investment.
Yes.
And I actually was following another guy recently who started buying NVIDIA shares at around 600. So already it had gone up. And his whole thesis was it's going to hit 1,000 because investors like the stock.
And he's right. And it did.
And guess what? As soon as it hit 950, he actually sold out his position.
Interesting. Yeah. So at that standpoint, again, if you're on social media and whatnot, you can see this bias play out. People, again, using NVIDIA as an example, people looking at NVIDIA saying, oh, it's a wonderful investment, and then jumping on now that the stock has appreciated significantly. Meanwhile, those people weren't jumping on,
I think it's like $100 and something
I think it was
like
about
18 months ago.
$180, give or take.
Yeah.
So it's appreciated fivefold over that amount of time. And so, there may be business fundamentals that drive some of that, but there's certainly market psychology that's also driven some of that.
When something rips like that.
Right. And the unfortunate part about our biases our bias would say that representatively that this is a good investment because it's gone up. Meanwhile, though, if the fundamentals don't keep up, actually this is probably a worse investment now than it was previously because it is appreciated so much.
Exactly.
Again, business fundamentals have to be looked into, but at the same time, you can't lump it into a good investment or bad investment just based on recent stock performance.
Right, because there's just too much psychology in the market.
There's a lot of psychology in the market, and you have to, sift into the fundamentals based on that to decide, okay, does this make sense or does it not make sense?
Yeah, and in 101 in the stock market, Phelps actually talks about this. He doesn't call it this because when he wrote, I don't even think behavioral finance was a discipline yet.
I don't think so.
It's fairly new.
Maybe in its infancy.
It's a fairly new discipline, yeah. And he was saying he said this as an example, he said a lot of investors buy based on if it's going up, it's a good investment. If it's going down, it's a bad investment. And he's like, that's terrible. He's like, it's kind of like a fish saying, well, I grabbed something that was moving once and it was good.
Yes.
Therefore, I'm going to grab this lure because it's moving. Therefore, it's good.
Right.
And of course, we know that.
The fish doesn't end well.
Right. And so, if a price is dropping, that forces you to look into the fundamentals. But oftentimes, in the long term, generally the market is right.
Yes.
But in the short term, there can be some nice opportunities because of this particular bias.
Well, think of Facebook as a recent example of that. So Facebook,
Meta.
Yes, sorry, Meta. So Meta stock cruised all the way up to, we'll call it almost $400 fairly recently, and then took a huge tumble as Mark Zuckerberg was talking about the metaverse, and investors soured, and they soured on it to the point where it went and dropped down to about $80 per share. Now, my own bias came in here because I was a Meta shareholder.
A pretty large Meta shareholder.
A fairly large Meta shareholder.
It was a large part of our portfolio.
But the funny part is that hurt to watch that go down. And this will speak to, loss aversion as a bias in part. But I should have been buying more at that point.
Well, we did buy more as it dropped. But
we did buy some more, yeah.
We bought more. We bought quite a bit more at 120. And then we would have bought more, but we were
kind of out of money.
We're kind of out of money.
But then you start wondering, you start lumping it in. Maybe it isn't a good investment. Right. I've lost half my money on this investment.
You start second guessing yourself.
Exactly.
You start second guessing everything because everyone's telling you it's stupid. The media is telling you that. Social media walls are telling you that. Your friends are telling you that. Everyone's telling you that. So like confirmation bias, if you were looking for it, you couldn't find it.
Also herd effect, which we'll talk about a little later. Yeah. But so all these biases come into play and say, oh, maybe you shouldn't be buying this stock, right? Yeah. And then you lump it into the bad investment because it's performed poorly.
Right.
Now, look at it at this point.
Lastly on this one, I guess what you could take away from it as far as trying to control your own emotional thinking is if a stock is dropping, just restudy it.
Yeah.
And be like, no, nothing's changed.
Nothing's changed in the fundamentals.
Right? And if a stock is, because like we referenced NVIDIA, if it's flying up, look at it.
Has anything changed in the business?
Maybe it's as good. Maybe it is that good.
Right.
Maybe it will still go up.
Yeah.
So look into it. See if that's so. And it's just a reminder, and that's probably the best way you can control that that particular bias. So the next one we'll cover is availability bias. Some people call it recency bias. I think we're all guilty of this, particularly just in life in general.
Sure.
We base a lot of what we think on what we hear most recently.
So what is recency bias, if you were to define it?
Okay, so recency bias is making a decision on the most recent information that you had, or maybe information that you really get bombarded with. So a good example of this actually is probably COVID-19. And we know that the death rate was up on everywhere you turned, you could see the death ticker going, and everyone was watching it. So we were all doing that. And what that did was it really made COVID-19, the virus, really recent. Really, we could access that information fast because we were bombarded with it, and it was something that was happening. And so the example of how this is kind of used against you is we were actually talking to someone, and we knew someone who had passed away.
Relatively young.
They were under 40.
Yep.
And right away, this person we were talking to say, oh, it must have been COVID. And I remember sitting there thinking, like, statistically, it probably wasn't. Because for someone that young, they weren't obese.
Nope.
So they didn't have any of the
risk factors.
They didn't have diabetes. They were a relatively healthy person. I'm thinking in my head, at that age, it was probably an accident or suicide, statistically.
Yes, statistically.
Right? Because I'm always thinking, right? Is this level one thinking or level two thinking? Like, I'm trying to always, like, do this in life. I'm learning. I'm getting better at it. I'm not great at it yet. But I remember in that moment thinking, and statistically, that's probably not true. And then I remember thinking, but it makes sense that this person would say that because recency bias is telling me, as I'm watching this death ticker, that everyone's dying.
And all the media is saying people are dying and whatnot.
That's all you're seeing.
And young people are dying. Oh, boy.
Right, yeah. You're seeing these mass graves in, like, New York, I think it was. You're watching news about Italy because this was way back at the beginning. And you're seeing the death counter go up and all of this other information. And sure enough, it turned out that it was not COVID.
Not COVID.
It was a different situation. But I was like, that is probably, I think COVID, that for availability bias just works so perfectly for so many examples.
Yeah. So how would that pertain to investing?
So with investing, we're going to go back to Meta. I think that's a good one. So one of the times it dropped, this is a different time, before this most recent 77 drop, there was another time it dropped. And that was because the Wall Street Journal came out with, it was called the Facebook files. This was actually pre-Meta. It was when it was still called Facebook.
Yeah.
And they were just coming out with like one bad article after another.
Yep.
And then they went through that Cambridge Analytical thing, and then that was all over the news. And so you were just getting like bombarded with negative news about Facebook.
Yep.
And so recency bias told me, do not invest in Facebook.
Right.
Because it's a horrible company.
You're seeing all these things telling you it's bad, it's bad, it's bad, it's bad.
Yeah.
Yeah.
And media is really bad for that, for recency bias or availability bias. And particularly now where media is just so in your face all the time. And so I actually bought there as well.
Yeah.
And it turned out to be
one of our best investments.
Yeah, a very good investment. But again, it's hard when your availability of information is all negative and you have to scour the reports and scour the numbers and listen to the conference calls. And really, it's emotionally difficult to get past that hurdle, because then you start thinking, do these reporters know something that I don't know?
Right.
So availability bias, recency bias, that's pretty easy to understand. So let's move on to the next one, which is anchoring. So why don't you talk about that?
So anchoring is basically where someone lets a specific piece of information kind of dictate their thinking or cognitive process. So probably one of the easiest ways to think about this is a house price. Okay, so when you're looking around at house prices, you may see a house for, $500,000. And that becomes the anchor price, right? And at that point, kind of everything is negotiated around that price. The other thing that you can think of is in terms of stock prices. People are constantly watching stock prices. So you may be following Celsius Holdings, for instance. So we know Celsius is the energy drink maker, and you may see that they had a recent 52-week low of $40 and a recent 52-week high of like $99. And it's trading close to their 52-week high. Yes. And you may be like, oh wow, I'm not going to buy it until it drops to close
back
to
down to 45.
It's 45 price. So at that point, it says nothing about the intrinsic value of the business, though. So whether it's trading at close to $100 or whether it's trading at $40, what is the business worth? Is it worth either of those two, or is it worth somewhere in the middle? So that's where anchoring comes in, and I think anchoring can be a bit of a problem in that it can lead you to make poor investment decisions just based on I'm going to only buy stocks at the 52-week lows, or I'm not going to buy it at the 52-week highs.
I'm going to sell it when it reaches if it falls.
If it goes,
I'm going to wait again for it to make that 52-week high, and it's like, well, who's to say it was even worth that 52-week high?
Well, and that's the other point. You bring up a very good point. You might anchor to your purchase price. So at that
100%.
So you might anchor the value of the business to the purchase price. Starbucks as an example. Let's say you bought Starbucks at like $90 and now it's trading in the 70s. And so you're unwilling to sell Starbucks at a loss, even though, let's say, the business fundamentals have changed.
Because you've anchored to 90.
Because you've anchored to 90. Or you won't bother looking into the business fundamentals to see if they have changed.
Right.
So this isn't advice to either go buy or sell Starbucks, but that we're using it as an example. But sometimes people are guilty of anchoring to a specific price point and then not going back and looking and seeing, okay, what is the actual value of the business at this point? Because it might be now that the business is only worth $70. Yes. So I think that's where anchoring comes in. It can lead you to make potentially poor decisions just based on fixed prices.
Based on numbers.
On numbers that don't mean a lot other than people's consensus at the time around the value of a business, which may be either accurate or inaccurate.
Yes.
Like that.
Yeah. So the interesting thing about anchoring is how it actually really does affect us. And the example that when I was reading and you were reading that, it said is that if the question read, was Gandhi older than 37 when he died? How old do you think he was? What would you put? You'd probably put somewhere 10 years, give or take, on the answer. Right,
or something like
that. And
that.
then the next question was Gandhi less than 115 when he died? What age did he die? You'd probably put like 90 or 80. Right. Because right away your mind anchors
to that high number.
Yes. Whether it's low or high. And we all do this. Yeah. And even recently, like, our son is getting married, and so we got the bill for the venue. Yep. And it was way less than we thought, and it's like
we were relieved.
It still wasn't cheap though, but we were like, oh, good, it's like way less than X, because our mind
had anchored to a high price.
Our mind had anchored to a high price, and it's still like crazy what it costs, but we're like relieved because our mind had anchored to some like made up price in our head.
And the other thing is, in investing specifically, I think you can maybe circumvent this bias to a point by doing your valuation before you look at the stock price. I know that's what Warren Buffett does.
That's very difficult to do now
when
the stock prices are everywhere and anywhere. It was easier to do that when you actually had to like have the physical newspaper in your hand. But
I mean, that's one way to potentially, let's say there's a company you don't really know about and you're like, oh, I'm wondering if it's publicly traded. if you look into it, or use Celsius Holdings as an example, let's say we didn't know that Celsius was public. We go, oh, I wonder if it's public. We look it up, and yes, it has an investor relations page. Don't look at the stock quote. Do a valuation of the business, and then figure out what the intrinsic value is per share, and then go see whether you should buy it or not. Problem is, it's a bit of a mental shortcut too, because it's easy to remember one number, right?
One nice round number.
One nice round number. So when valuing a business, there may be a range of values. So, I mean, at this point, it's interesting because markets are based on quotations. I mean, there has to be a number.
There has to be a
right?
number.
So everyone's going to buy, sell on a stock.
You got to put a story to the number.
Right, but you got to put a story to the number, and then you got to figure out what a business is worth. And I think that's one way you can circumvent that bias to a degree.
So let's do one more and end there because it's taking a little while. And we're going to end with gambler's fallacy, which you actually found super intriguing. So I'm going to let you take that away.
Yeah, so basically gambler's fallacy is a misunderstanding of probabilities. So I'm going to use maybe more of an example to explain it than a definition. So the gambler's fallacy would say that, okay, well, let's say we have a fair coin and I flipped heads 10 times in a row. Well, that's highly improbable, right? That I've flipped 10 heads in a row. And you may say, well, and I wager you, I say, I'm going to bet you, you want to make a bet that is going to continue. And you say, there's no way it's going to continue that you're going to flip another heads because it's been so improbable that you flip 10 heads in a row that an 11th head is going to be completely improbable.
The odds are in my favor.
The odds are in your favor. You're thinking the odds are in your favor. But that's a fallacy because it's not. Because each coin flip is 50-50 if it's a fair coin. It's independent, right? So each coin flip had a 50-50 chance of landing on heads or tails. And so from that standpoint, it's like the people who play the slot machines and they haven't won for a while. So they're sitting at the same slot machine and they've lost 10 times in a row. Okay, well, this one's going to be a winner. This one's going to be a winner. Meanwhile, though, the slot machine is programmed a certain way. It has no
roulette.
Roulette's another one. So it's a misunderstanding basically of probabilities. And so how that will boil down in stocks is oftentimes maybe watching a stock drop. And so we may go, oh my, it's dropped 3 trading sessions in a row. There's no way it's going to drop another one. Or it's already going down 50%. There's no way it can go down another 50%. Meanwhile, it can because it's not based on that in terms of events. Or a stock is appreciated this much. It's not going to continue to go upwards.
Right. We've gone up 4 days in a row.
We've gone up 4 days in a row, right?
I'm going to short it or whatever.
Right. So because stocks are maybe a little different than a coin toss, but at the same time, people will run into that as a potential fallacy.
The thing that I read that was interesting to this, and gambler's fallacy wasn't my favorite because I don't think it's as important.
It's not one I struggle with as much.
I don't really know anyone who struggles with this one, but one thing they said is people who really fall trap to the fallacy are people who misunderstand the law of large numbers.
Sure.
Right? So with a fair coin, you might get 10, 20 heads in a row. Yeah. But if you do that flip 2,000, 5,000 times, it's going to probably be...
It's going to be even.
Yeah, not probably. It's going to be very close to 50-50.
That's right.
Right? And so they said it's a misunderstanding of the law of large numbers. Now, I do like studying it because, again, I want to always have that system too, thinking in check when I'm talking to people or when I'm contemplating things or when I'm making decisions. So it is still good to understand gambler's fallacy, but I find personally in the stock market, I don't even fully know how I would implement that fallacy.
I think the way that I think
if I was a trader, maybe it'd be more
or you're playing earnings.
Or playing earnings.
Something like that.
I don't do that.
I don't either. So I think maybe if you're a person, who likes to play earnings and stuff like that, I think it is more for shorter term traders potentially that it might impact them because they're going to be dealing with that kind of stuff. I think one of the things I would say is it may help you reflect if you recognize it as a potential fallacy to look at everything probabilistically. I think that's maybe where you should reflect on it as an investor. So it may be that you develop models more based on probabilities.
Right, and not based on outcomes.
And not based on necessarily outcomes.
Right, because I think gambler's fallacy is saying we as humans like to base things on recent outcomes, but a lot of times an event is a separate situation in and of itself, not based on previous outcomes, good or bad. And I guess that's where we get things like, things happen in threes. Yeah. And it's like, well, that's not necessarily true.
That's right. And I'm actually going to recommend a book by Annie Duke called Thinking in Bets. It's a book. She's a professional gambler. You may or may not have heard of it, but she writes a very good book, basically encouraging just people in general to think in bets because life is all about probabilities. Investing is a game where there is probabilities. No one knows the future for certain. So you may have a probability one way or the other. And I think it's good to look at doing valuations and assessing companies and business prospects as probabilities.
Yeah. So I think we'll end up there because that's been a pretty decently long conversation.
Yeah.
We'll pick up some more fallacies next week that will help us to become better investors. And I will end with saying, I don't know who said it. He said, the only thing I can do is know my biases and then hope that I can control them.
Right. I think that's a great quote.
He said even knowing them doesn't necessarily help him control them.
I know mine, and I still let them control me.
So he said the best thing to do is to just know they exist and then figure out how I'm going to deal with them.
Yeah.
So we'll end there. If you can like and subscribe this video, that would be really great. And we will see you next week.